There is a tax rule that affects more than half of all Social Security recipients in America, and most of them have never heard the name of it. It is called provisional income. And the reason it matters is not just that it can make your Social Security taxable. It is that it creates a hidden tax rate inside your retirement that can hit 40, 50, even 55% on certain dollars of income, while your tax bracket on paper says 22. The IRS never sends you a letter explaining this. Your employer never warned you about it because it did not apply when you were working. And most tax software just calculates the damage after the fact, without ever showing you how to avoid it. Today, I'm going to show you exactly how provisional income works, what triggers it, what it actually costs you in real dollars, and the specific moves that reduce it. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Jake Retires. Every week, I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Let me start with the formula because once you see it, everything else clicks. The IRS calculates your provisional income by taking your adjusted gross income, adding any tax-exempt interest you earned, and then adding half of your Social Security benefits. That total is your provisional income. And that one number determines how much of your Social Security gets taxed. If your provisional income is below $25,000 as a single filer, or below $32,000 as a married couple filing jointly, none of your Social Security is taxable. Zero. If your provisional income is between $25,000 and $34,000 single, or between $32,000 and $44,000 married, up to 50% of your benefits can be taxed. And if your provisional income crosses $34,000 single or $44,000 married, up to 85% of your Social Security becomes taxable income. Those thresholds were written into law in 1983 and 1993. They have never been adjusted for inflation, not once. A provisional income of $25,000 in 1983 represented a comfortable retirement. Today, it catches a retired teacher living modestly in the Midwest. The Social Security Administration estimates that 56% of all recipients now pay federal income tax on their benefits. In 1984, that number was about 10%. The thresholds did not move. Inflation did, and tens of millions of retirees got pulled into taxation they were never supposed to face. Now here's the part that most people never see, and it is the part that actually costs you money. It is not just that your Social Security becomes taxable. It is what happens to your effective marginal tax rate when you are sitting inside that provisional income range. Let me show you with real numbers. Say you are a single filer and your provisional income is $30,000. You are in the zone where up to 50% of your Social Security is taxable. You decide to take an extra $1,000 out of your traditional IRA. That $1,000 increases your adjusted gross income by $1,000, but because it also increases your provisional income by $1,000, it pulls more of your Social Security into the taxable zone. For every $1 of additional income you bring in inside that lower bracket, 50 cents of previously untaxed Social Security becomes taxable. So that $1,000 IRA withdrawal does not just add $1,000 to your taxable income, it adds $2,500. Your actual tax rate on that extra $1,000 is not 12%. It is closer to 18% because you're paying 12% on $1,500 worth of taxable income. Now move into the upper bracket, the one above $34,000 single or $44,000 married. For every extra dollar of income you bring in there, 85 cents of Social Security becomes taxable. So that same $1,000 IRA withdrawal adds $1,850 to your taxable income. If your marginal rate is 22%, you are effectively paying 22% on $1,850. That works out to an effective rate of roughly 7% on that $1,000 withdrawal. On paper, you are in the 22% bracket. In reality, you are being taxed at 40%. That gap is what nobody explains. Let me put a full dollar amount on this so you can see the real cost over a retirement. Take a married couple, both 68. Combined Social Security is $36,000 per year. They have a traditional IRA worth $600,000. They take $40,000 per year in IRA withdrawals to cover living expenses. Their provisional income is $40,000 from the IRA plus $18,000, which is half of their Social Security. Total provisional income, $58,000. That puts them well above the $44,000 upper threshold for married filers, which means 85% of their $36,000 in Social Security, or $3,600, is taxable. Their total taxable income before deductions is $40,000 from the IRAs plus $3,600 from Social Security. That is $70,600 in taxable income on $76,000 of actual cash received. Now compare that to a couple with the exact same Social Security and the exact same spending needs, but who did Roth conversions during their gap years and now draw $40,000 from a Roth IRA instead of a traditional IRA. Roth withdrawals do not count in the provisional income formula. Their provisional income is just the $18,000, which is half of Social Security. That is below the $32,000 lower threshold for married filers. 0% of their Social Security is taxable. Their taxable income is zero before deductions. Same cash in their pocket, same lifestyle. Completely different tax bill. The difference, $30,600 in taxable Social Security income at a 22% rate, is $6,132 per year. Over 20 years of retirement, that is $134,640 in federal income tax paid on Social Security benefits by two people who had the same income as their neighbor who paid nothing. The only difference was the source of the withdrawal. Now here's where it gets more complicated and where most retirees get surprised. Tax-exempt interest counts in the provisional income formula. Municipal bond interest, the kind that is completely free from federal income tax, still gets added to your provisional income. That is not a typo. Interest that does not appear on your taxable income line still pushes your provisional income higher and can make more of your Social Security taxable. So a retiree who shifted money into municipal bonds specifically to reduce their tax bill can end up increasing their Social Security taxation without realizing it. The interest never shows up as income, but it quietly raises the threshold calculation, and the result is more Social Security in the taxable zone. This is one of the most counterintuitive pieces of the entire tax code. The thing you bought to avoid taxes is making your Social Security more taxable. If you hold municipal bonds and you collect Social Security, you need to run this calculation before your next tax year, not after. There are 4 specific moves that reduce provisional income, and each one works differently. The first is Roth conversions during the gap years, the period between retirement and age 73 when RMDs begin. Converting traditional IRA money to a Roth during those years reduces your future RMD amount. Smaller RMDs mean lower provisional income in the years when both Social Security and RMDs are hitting at the same time. The key is converting just enough each year to fill your current bracket without crossing into the next one. A tax advisor can calculate that exact number for your situation. The second move is qualified charitable distributions. If you're 70 and a half or older, you can send up to $111,000 directly from your IRA to a qualifying charity. That distribution counts toward your required minimum distribution, but it does not count as income. It does not appear in your adjusted gross income. It does not increase your provisional income. If you were going to donate to charity anyway, routing it through a QCD instead of writing a personal check is one of the cleanest tax moves available to retirees. The third move is being strategic about when you take capital gains. Long-term capital gains are included in your adjusted gross income, and they count toward provisional income. If you're selling investments in a taxable brokerage account, spreading those sales across multiple years instead of one large sale can keep your provisional income below a threshold that would otherwise make your Social Security taxable. 1 year of big gains can cost you thousands in Social Security taxation that a 2-year spread would have avoided entirely. The fourth move is reviewing how you hold municipal bonds. If the tax-exempt interest is pushing you over a provisional income threshold, you may be better served by a different fixed income strategy that does not add to provisional income. This is a case where the conventional wisdom, buy munis to reduce taxes, breaks down completely in the face of the provisional income formula. Here is what most retirees actually do. They retire. They start collecting Social Security. They take IRA withdrawals when they need money. They get their taxes done in April. The software produces a number and they pay it. Nobody shows them the provisional income calculation. Nobody shows them that the withdrawal they took in October triggered $850 in additional Social Security taxation they could have avoided by taking $20,000 less from the IRA and $20,000 from the Roth they converted 5 years earlier. Nobody shows them that the municipal bond interest they were so proud of is working against them. The IRS collects the money either way. Your tax software files the return either way. The only person who loses is the retiree who never saw the formula. And the tragedy is that, in most cases, the fix is not complicated. It is timing. It is source selection. It is knowing which account to pull from and which year to stay below a threshold that changes everything. That is not magic. That is math. And it is math that most retirees have access to. They just never knew they needed to run it. Here is the bottom line. The provisional income formula is the single most important tax calculation in retirement that almost nobody understands before it is already costing them money. It is not enough to know your tax bracket. You have to know your provisional income, where it sits relative to the thresholds, what each additional dollar of income actually costs you an effective tax rate, and which moves reduce it before the tax year closes. If you have never seen this calculation done for your specific numbers, that is the first thing you should ask a tax professional to run, not your general tax return. This specific calculation: provisional income, Social Security taxation percentage, effective marginal rate on each income source. That conversation could save you thousands of dollars every single year for the rest of your retirement. This is Jake Retires. If this video helped you, hit the like button right now. It takes 1 second, and it helps this video reach more retirees who need to hear it. If you're not subscribed yet, hit subscribe and turn on the bell so you do not miss the next one. If you know someone collecting Social Security who has a traditional IRA, send them this video today. They are almost certainly paying more tax than they should be, and they have no idea. Drop a comment below. Did you know about the provisional income formula before this video? Are you in the zone right now? I read every single one, and the most common situations become future videos. I will see you in the next one.